Spotify's stock dropped more than 13% at the start of trading after the company released a weaker-than-expected profit outlook for the second quarter. The big question is, was this sharp decline just a knee-jerk reaction from the market, or is it a warning sign that Spotify's valuation is losing its shine? Founded in 2006 in Sweden, Spotify has grown into the world's largest music streaming platform. With more than 760 million monthly active users and nearly 300 million premium subscribers, Spotify dominates the global digital music market. Beyond music, the company has expanded into podcasts and audiobooks, positioning itself not just as a streaming service, but as a global audio hub that continues to evolve. Spotify continues to dominate the global audio streaming market, holding nearly one-third of worldwide share. With over 760 million monthly active users and close to 300 million premium subscribers, Spotify's scale is unmatched. Competitors like Apple Music, Amazon Music, Tencent Music, and YouTube Music are growing, but none have managed to close the gap. Apple Music, for instance, controls just 12.6% of the market, while Tencent Music leads in China with 14.4%. Amazon Music and YouTube Music trail further behind at around 11% and 10% respectively. What sets Spotify apart is not only its massive user base, but also its diversification into podcasts and audiobooks, creating an ecosystem that goes beyond music. This strategy strengthens engagement and monetization, giving Spotify a competitive edge. Still, the company faces pressure from rivals with deep pockets and integrated ecosystems, Apple with its devices, Amazon with Prime bundles, and YouTube with its video dominance. In short, Spotify remains the clear leader in streaming, but the competitive landscape is intensifying. Investors must weigh Spotify's scale and innovation against the risk of margin pressure as rivals fight for market share. Spotify's stock fell nearly 13% in early trading on April 28, 2026, despite beating Q1 earnings expectations. The sharp drop was driven by soft guidance for Q2, particularly weaker-than-expected premium subscriber growth and lower operating income forecasts. Spotify's latest earnings report delivered strong first-quarter results, but the market focused on weaker guidance for the second quarter, sending the stock down nearly 13%. In Q1 2026, revenue grew 14% year-over-year to €4.5 billion, slightly above estimates. Monthly active users climbed to 761 million, while premium subscribers reached 293 million, up 9% from last year. Gross margin expanded to 33%, one of the highest in company history, and operating income came in at €715 million, beating guidance. Despite these impressive numbers, investors turned cautious after Spotify projected softer Q2 performance. The company expects 778 million monthly active users and 299 million premium subscribers, just shy of analyst expectations. Operating income was guided at €630 million, well below Wall Street's forecast of around €680 million. Management even noted that guidance was subject to substantial uncertainty. Adding to concerns, advertising revenue grew only 3% year-over-year, highlighting weakness in the ad-supported business. Meanwhile, rising costs from AI-driven R&D and marketing could pressure margins, even as Spotify raises subscription prices in the US from $11.99 to $12.99 per month. The result, a sharp sell-off, as investors weighed strong current performance against a more uncertain near-term outlook. Now we are looking at a small portion of Spotify's financial ratios for fiscal years 2025 and 2024. In fiscal year 2025, Spotify recorded a gross margin of 31.98%, meaning that for every €100 in revenue, about €32 remained after covering the cost of content and distribution. This was an improvement from 30.14% in fiscal 2024, showing stronger efficiency in managing costs. Return on invested capital, or ROIC, stood at 20.68% in 2025, up from 16.68% the year before. In simple terms, for every €100 of capital invested, Spotify produced about €21 in returns in 2025, compared to €17 the year before. This indicates Spotify generated higher returns from the capital invested in its business, a sign of improved profitability and capital allocation. Spotify's free cash flow margin reached 15.24% in fiscal year 2025, compared to 12.19% in 2024. This percentage shows how much of the company's revenue is converted into free cash flow after covering operating costs and capital expenditures. In simple terms, for every €100 of revenue, Spotify kept about €15 as free cash flow in 2025, versus €12 the year before. The improvement highlights stronger cash generation efficiency, giving Spotify more flexibility to reinvest in growth, pay down debt, or return value to shareholders through buybacks and dividends. A rising FCF margin is a positive signal of financial health and resilience. Finally, interest coverage rose to 7 times in 2025, from 3 times in 2024. This means Spotify's operating income was 7 times greater than its interest expenses, a significant improvement in financial stability and debt servicing capacity. Looking ahead, Spotify's medium and long-term prospects remain strong. Despite near-term volatility, the company is positioned to capture significant growth opportunities worldwide. Today, only about 3% of the global population pays for Spotify, leaving vast room for subscriber expansion, particularly in emerging markets across Asia, Latin America, and Africa. Pricing power is another key driver. Recent subscription increases in the US and Europe have shown minimal churn, proving Spotify can raise prices while maintaining loyalty. This supports average revenue per user growth, which is expected to continue climbing in the years ahead. Financial resilience adds further confidence. Gross margins have steadily expanded, free cash flow is rising, and the balance sheet remains strong with billions in liquidity. This gives Spotify flexibility to reinvest in innovation and shareholder value. Finally, product innovation is set to deepen engagement. AI-driven features like AI DJ and Song DNA are already attracting tens of millions of users, while programmatic advertising is expected to reach an inflection point in 2026, unlocking higher margin revenue. Expansion into podcasts and audiobooks diversifies the business model, making Spotify more than just a music platform. Taken together, these catalysts, global scale, pricing power, margin expansion, and innovation, support a bullish outlook for Spotify in the medium and long term. For investors, the story is less about short-term guidance and more about the company's ability to sustain growth and strengthen its leadership in global audio streaming. Despite Spotify's scale and innovation, several risks could weigh on its stock price going forward. Advertising revenue remains a weak spot, growing only 3% year-over-year, far below subscription growth. This raises concerns about Spotify's ability to diversify beyond premium subscriptions and scale its ad-supported business. Rising costs also pose a challenge. Heavy investments in AI-driven R&D, infrastructure, and marketing increase operating expenses, and guidance for operating income has already come in below analyst expectations. Margin pressure could persist if revenue growth slows or costs escalate further. Regulatory and compliance risks are another factor. Spotify has intensified its crackdown on artificial streaming practices, removing millions of tracks and freezing accounts linked to bots. While necessary to protect credibility, these actions risk alienating independent artists who rely on visibility. At the same time, Spotify has tightened API access, shutting down thousands of third-party apps. This move prioritizes its own AI DJ and playlist features but could reduce ecosystem diversity and frustrate developers and users. Finally, competition remains fierce. Apple Music, Amazon Music, Tencent Music, and YouTube Music all leverage broader ecosystems, devices, bundles, and video, to challenge Spotify's market share. Unlike these rivals, Spotify relies primarily on subscriptions and advertising, which may limit its ability to defend margins while sustaining growth. Taken together, weak advertising growth, rising costs, regulatory challenges, and intense competition form a set of negative catalysts that could pressure Spotify's stock in the near to medium term. We are now looking at Spotify's stock valuation, where its fair value is estimated to be around $580. Although the current share price is below this fair value, market participants should remain cautious because, in the short term, Spotify's stock price may continue to face downward pressure. This is triggered by the company's pessimistic outlook for the second quarter of 2026. In conclusion, Spotify's story is one of scale, innovation, and opportunity balanced against near-term challenges. The company continues to expand its global user base, strengthen pricing power, and deliver margin improvements, while AI-driven features and diversification into podcasts and audiobooks enhance engagement and long-term growth prospects. At the same time, investors must weigh risks. Advertising revenue remains soft, rising costs from AI and marketing could pressure margins, and competition from ecosystem-driven rivals like Apple and Amazon is intensifying. Regulatory crackdowns on artificial streaming and tighter API access also add uncertainty. For investors, the key takeaway is clear: while short-term volatility may persist, Spotify's medium and long-term catalysts, subscriber expansion, ARPU growth, and product innovation, support a constructive outlook. The balance between these strengths and risks will determine whether Spotify's stock can unlock its fair value potential and sustain upward momentum in the years ahead. This content is for educational purposes only and does not represent financial advice. Thank you for watching, and don't forget to like and subscribe for more insights.